We've talked in prior videos about the price of insurance and how it's calculated. We know there are hundreds of factors that go into determining your insurance premium, but today we're going to talk about only one of those factors. It's an exciting factor. It's actually a factor that gets some people really upset. Today we are going to talk about credit and how your credit score affects your insurance premium. The first thing we're going to talk about is which companies actually use credit to determine your insurance premium. You might be surprised to know that 92% of all insurance carriers in the United States are using credit when determining your insurance premium. There are only a handful of insurance carriers and a handful of states, Michigan, Massachusetts, and Hawaii are three of them that I know of, that actually prohibit the practice of using credit when determining your insurance premium. But besides from those few states and a few carriers, everybody in the insurance world is using credit to determine your insurance premium. One important thing to know is that insurance companies are not pulling your official credit score. So like a 750 credit or a 690 credit or whatever it may be, that's not what insurance companies are pulling, and that's not what they're using to determine your insurance rate. They're essentially using four things to determine your insurance rate through credit. Those four things are your payment history, the length of credit history, the types of credit you have, and how much debt you have. Those are the things that insurance companies are looking at. So they're not looking at your official credit score like a financial institution may. They're coming up with their own factors to determine your insurance credit score. And now, according to the Insurance Information Institute, insurance companies will not use personal information such as gender, your job, your income history, or any other personal information like that to determine your insurance credit score. It's also important to note that insurance agents and brokers like ourselves, we don't get a laundry list of your credit history. We don't get an eye into your credit history, your financial history. We don't get to see all of that. So you don't have to worry about some random insurance broker running your credit and seeing all of that. We see very little. In fact, anytime we do see something, it's usually a number scale. There's a lot of insurance companies, Travelers is one of them, Allstate is one of them, who use a number scale anywhere from like 1 to 30. 1 being the very best credit, 30 being the very worst credit, but that's all we see as insurance brokers. Another question that we get often is it a hard pull or a soft pull? Well, we talked about it's not an official credit score like a financial institution would pull. It's a soft credit pull. You're not going to see it show up. It's not going to affect your credit score. It's not going to negatively impact it and drive it down lower. You won't see any of that happening when you get insurance quotes and they run your credit. And here's the thing, just as a very bad credit score can make your premium very bad or very high, well, a really good credit score can help your insurance premium be even better. People with above average credit scores will pay a lower rate than somebody who does not have good credit. But one important thing to point out is, and again, we've talked about this, there are a number of different factors that go into determining your rate. So just because you have a really good official credit score, that is not always going to turn into a really good insurance premium. However, all other things remaining equal, somebody with really bad credit, they're essentially going to double their insurance rate, versus somebody with really, really good credit on the other end of the spectrum, they're probably going to cut their insurance rate in half. So you can see if all other things are equal, there is a huge swing in premium between someone with really good and someone with really bad credit. So now here's the last question. Why do insurance companies even use credit to determine insurance premiums? Doesn't make sense. I could have just foreclosed on my home or some other bad thing happened and I have really bad credit, but I've never had an accident. So how does that make sense? We hear that often. As we talk about often, however, insurance companies use data. They use numbers. They're not pulling these premiums out of thin air. They use data, and that's how they back up all of the rates that they set. So, believe it or not, there actually is data that shows a direct correlation between those people with bad credit and those people that get into accidents often. And those people with good credit tend to not get in as many accidents as those with bad credit. So there is data that backs this up so that insurance companies can do that. And as long as the data continues to back that up and prove that there is a direct correlation, guess what? Insurance companies will continue to use credit as a factor when determining your insurance premium. So what can you do? Well, you're definitely not going to change the insurance company's mind, but you can work with a professional or work with whoever to get your credit score better, and you will see over time as your credit gets better. Don't have any accidents or tickets, but as your credit continues to get better, you should see a decrease in your insurance premium. Thank you for watching, guys. As always, please reach out with any questions if you'd like more details, if you'd like us to hold your hand and walk you through the insurance buying process. We are more than happy to do that. Our whole goal is to educate. We want to educate 10,000 people. So never hesitate to reach out and ask questions, no matter how small or how stupid you may think they are. We want to help. We want to educate. So please reach out. Thank you for watching, guys, and we will see you in the next video.